Welcome back to Click Capital, everybody. I hope you had a great long weekend. And if you're an NVIDIA bull, I would be very nervous because we've just got the famous kiss of death from none other than Jim Cramer, who just recently made a tweet that people are deriding the valuation of NVIDIA, but the valuation is more of an art than many would like. He goes on to say, if NVIDIA is right, then every major company, save Apple, is dependent on it. Everyone. What is that worth? The subject is daunting, humbling. And this is coming from a guy who is famously wrong. He's actually more wrong than random. This is a quantitative site that takes a short position in all of his most recommended stocks. And since 2021, that has been significantly outperforming the market. But for some reason, the media holds him up like some financial guru, when really he is chronically wrong just about all the time. And it's just another classic move you see from the media when you see a stock up 10x over the last couple of years, and now he's starting to talk about valuations more of an art. And I do feel sorry for all the people that do follow Jim Cramer and wonder how many billions of dollars has he managed to lose people over the years. And as I predicted last week, we're already starting to see the insiders starting to cash in on the hype, with one board member just announcing that he's going to offload 100,000 shares, which will bring him in about $38 million. And this is a trend we've been seeing for a couple of years now in the NVIDIA stock. Every time the stock gets a big run up, insiders dump it onto the public. Last time back in late 2021, we had Jensen Huang, the CEO, offload $270 million worth of stock. And I'd be very surprised if in the next couple of weeks, maybe month, if we don't get a report that he's offloaded more stock. And he is the master of hype. Here he is here, a photo of him just this Friday night, wandering around in Taiwan at the food markets. And he's played it so well, even coming out with more news over the weekend of some new products just to keep the hype going alive. And of course, that saw the stock gap up again today, opening at 405. We got up to almost 420, so past $1 trillion in market cap. And I used that run up to add to my short position again, getting filled just under 414 shortly after we opened. I also added to my long-term position in Tesla, as I'm a long-term permanent holder. And stay with me in this video. I'll let you know what other stock I shorted today and another ETF in my long-term portfolio I added to, as I believe it is a good buy here. And it won't be just NVIDIA insiders selling to the public. The company itself is going to use this opportunity as well, as they've just signaled that they may offload $10 billion worth of stock in a secondary offering. And something you often see when you get a crazy stock price, the company will sell more stock to the public to take advantage of that. And with some people saying there's simply not enough market cap available to support the buying mania for artificial intelligence, long-time successful short seller Jim Chanos said, oh boy, the short seller known Wall Street is quite good at creating supply to meet demand. And wanting to defend her decision to get out of NVIDIA earlier this year and miss out on the run-up completely is Cathie Wood saying, NVIDIA is not the only AI play. There's lots of other overvalued AI companies that she owns. But again, I don't know why she has 1.6 million followers on Twitter and the media holds her up as a guru. Because if you look at a long-term chart of her flagship fund ARK versus the NASDAQ here in the orange line, you'll see the NASDAQ is up 560% since ARK IPO'd back in 2014. And she's only up 94%, so she's chronically underperformed the market. But once again, for some reason, the media looks to her for all the answers on these innovative companies. And once again, as predicted, Joe Biden and Kevin McCarthy kicked the can and will continue spending your tax, time, labor into infinity until they are stopped. And they've agreed to raise the debt ceiling until January 2025, conveniently after the next presidential election, with no real material cuts on spending. And so you can expect your public debt, currently at $31.5 trillion, to continue blowing out, which is already about $100,000 for every single man, woman, and child in the United States. And unfortunately for younger people, especially the millennials, you're going to have to work a lot longer and harder to pay all this back thanks to the boomers. So this deal should be pushed through the House and Senate this week, as markets had been expecting. And the saying, go woke, go broke, is well and alive, with Bud Light sales in freefall. I'm sure a lot of you have seen the photos with stores around the country just overflowing with Bud Light inventory and deep discounts, and soon enough just looks like they can't even give it away. And to add insult to injury, the clown that Bud Light hired to promote their brand, Dylan Mulvaney, has actually come out and after apparently being a woman for a year has now revealed he's actually interested in women. So it appears Bud Light and a few other brands have been pretty well played by this person. And if these brands are going to get political, then you're going to cut your customers down the middle. And we can see that in the stock price of Anheuser-Busch getting absolutely slammed again today, down almost 5%. So not only did they alienate their customers, they're also alienating their investors who don't want to hold the stock anymore. And we're seeing the same thing in the stock price of Target, coming down really hard today, really deep oversold territory. As they try to market it really controversial, ideological clothes to little children, customers and investors are responding to that and voting with their dollars. Also, riding the AI hype train is C3 AI, was absolutely ripped today ahead of its earnings tomorrow. We can see that here in the stock price, up to $44 a share on huge volume. However, I do believe it is a sucker's rally because insiders do nothing but sell every time we get a spike up. So you can expect the same again in a few days. They will hype it up. The company's got a long history of changing the name of the company to whatever the latest fad is. Hindenburg Research, the same short seller that's gone after Carl Icahn, actually released a report on this company back here as well, stating that their numbers and accounting is quite questionable, and the culture of changing the company name to whatever the latest fad is. Plus the business itself, you look at these last couple of quarters, it's just not even no growth at all, and it is consistently lose money. They're doing $70 million a quarter, and it's got a market cap now approaching almost $5 billion. However, that's the stock market for you. It's going to do crazy things in the short term before the fundamentals kick back in. And I think this is making the market overall more and more of a phony market. And that's why Berkshire Hathaway has actually been a net seller of stocks so far this year, sitting on $88 billion in cash. They're saying they just can't find anything worth putting their money into. Even Elon Musk is warning the alarm on real estate, saying commercial real estate is melting down fast. Home values are next. And it looks like the days of easy money are behind us, with the hucksters like Chamath already cashing in on the SPAC trend. Apparently executives and early investors sold $22 billion worth of SPACs to retail and absolutely cleaned up on the craze. And just looking at the heat map here today, the market continues to become more and more split down the middle, continuing to see weaker breadth with most sectors trading soft and mega cap tech holding up. There's Tesla, had a good day today, and of course NVIDIA. A little bit of economic data out today. We saw home prices month over month increase 1.5%. Consumer confidence came in a little bit better than expected. Manufacturing still weak. And we've got a bit of jobs data out later this week with JOLTS job openings tomorrow. And then we've got ADP employment on Thursday. Weekly jobless claims and the big one, non-farm payrolls on Friday. So the Fed will be really looking to that for their decision in June. But as it stands today, Fed Fund futures are pricing in 62% chance that the Fed will hike next month. And we've got a better chance that they're going to hike again in July than stay where we are now. Market's still loving the tech AI rally with the fear and greed index at 65. Another busy day in the options market, almost 40 million contracts changing hands. And a huge 58% of them were calls. And it's just crazy when you look at the put percentages, how low. Only 39% in NVIDIA, 33% in Tesla, and all the other mega cap techs as well. People just loading into the call options. Dark pool buyers hanging in there with slightly bullish reading on the DIX index at 49%. Corporate insiders still selling more stock than they're buying. And while stock market valuations, like if you look at things like forward PE, they aren't too bad when you compare it to itself historically. When you compare stock market valuations relative to bonds, they're really overvalued. And don't forget how cyclical profit margins can be. Here's a chart of the operating margin of the SP 500. And we can see that peaked out in 2021 at 13.5%, but the long-term average is a bit more closer to 9%, so you'd expect some reversion to mean. And for that to happen over the next couple of years, year or two, if we get a recession especially, that's going to push the current multiples up a lot higher than where they are now, especially relative to bonds. And never before have we seen so much of the S&P 500's performance this year come from the top 10 largest stocks in the index. So the S&P is up 9.2% this year. 95% of that performance has come from the top 10 stocks. The only other year sort of close to that was 2007, when 78% of the performance came from the top 10. And that was right before the market crashed big time in the GFC in 2008. Similar pattern again in 1999, right before the tech bubble burst and the NASDAQ came off 80% over the next 2.5 years. And here's another chart to illustrate this point with the NASDAQ index, which has gained $4 trillion in market cap this year. The bottom 93 stocks in the index has only contributed a little under 16% of that gain, with 17% of the gain coming from Apple, Microsoft, NVIDIA, Alphabet, Amazon, Meta, and Tesla. So this is a really funny market where you've got most stocks in the market actually weak, and then you've just got a handful of the biggest guys doing really exceptionally well. It just makes you wonder how much longer can that go on. And if you look throughout market history, typically high PE stocks, that's overvalued stocks, typically underperform low PE undervalued stocks. And so this is a chart of the 10-year annualized outperformance at a high PE versus low PE. And you can see that's mostly negative over time, but throughout the dot-com bubble up to 2000, they actually outperformed annualized 2.4%. That broke records in COVID going into 2020 when we saw the growth value spread absolutely blow out and got annualized outperformance of 6.2%. Now that's come back down, but it's still well above its average, which is actually more closer to a negative 8 or 10. And something that could cause that reversion to the mean is something we see every time going into a recession, and that's banks tightening their lending standards. In other words, making it harder to get loans and credit, which is the big driver of the economy. And so now we've got over half of banks tightening their lending standards, and every time we've hit that figure, we've gone into a recession marked in the grey zones here. So it's very hard for an economy to grow if credit is being suffocated like it is now. After the Silicon Valley bank crisis, all banks are tightening their lending. Okay, back over to the charts. We saw the SP500 get up to 42.31 today. NASDAQ found new highs for the year as well, now sitting in a bit of a resistance zone. And I'll just take you out to a weekly chart here. And if we do a Fibonacci on the October low from the November high, you can see the NASDAQ has now done a 61% retracement and now moving into what they call the golden pocket. So this could be a point in time where the market stalls out on the NASDAQ. And we actually saw a similar pattern back in 2008. So we had the bull market running into late 07. Then we sold off, bottomed down in March, and then we actually made that 61.8% retracement of that move. It stalled out, fell, retraced a little bit, and then completely crashed into the first quarter of 2009. And we can see that move after it stalled out was actually 50% drop before it found a bottom. And this is a weekly chart of the amount of stocks on the NASDAQ making new highs. And this is back in 2007, 2008. So you can see that was consistently in the mid 100s. Then in 2008, it really fell off. Then we made that 61% retracement. And you can see when it retraced, the amount of stocks making new highs got nowhere near back to its late bull market peak. And here we are again today. So we can see in 2021, the amount of stocks making new highs got really crazy, even up into the 300s, as it was such a huge overbought level on the market on so many measures. And then the breadth has just completely collapsed here, and we're still not hitting new highs on the amount of stocks in the NASDAQ making new highs. So the breadth is just not there in the market, which is a sign of an unhealthy bull run. A healthy bull market, you'll see most stocks breaking out to new highs. However, as we've just been going over, it's just a concentrated top end of the market that's really pulling the main indices higher here. So just looking at the NASDAQ here, it's looking very technically overbought. We've got a lot of people buying call options, and we've got a lot of people saying, it's a new paradigm. Jim Cramer's saying, valuations don't really matter. It's more of an art. In my opinion, now's a time to be very cautious and careful on this market. And we actually saw the other indices, the Dow, mids, and smalls all come off today. Internationals are weak as well. Here's Canada's TSX. The UK FTSE coming down. German DAX looks to have lost momentum. Japanese Nikkei has had a good run, but looks to be stalling out a little bit. And the Aussie and China trading weak as well. The new VIX one-day index dived today after we got the debt ceiling deal done. And the regular VIX 30 days holding up at around 17.5. Bond market volatility is still really elevated versus stock market volatility, as much as it's ever been. So the bond market's still saying we are not out of the woods yet. There is still dark storm clouds on the horizon that the stock market is just not acknowledging. And look at that put-call ratio on equities, super low, 0.73. That's typically a really good contrarian signal when everyone's buying calls. And there's weak breadth again, only 35% of stocks above their 20-day average. Still got more than half of stocks below their long-term 200-day average. And look how overbought the spread is between growth versus defensive sectors. So I've just seen that big rotation the last couple of weeks, but this is getting to real extreme levels here. Same with high beta stocks versus low volatility stocks, and the growth versus value spread. Commodities still having a hard time here, with the copper gold spread predicting weaker economic activity ahead. And commodities versus stocks continue to trade down to new lows year to date. International stocks as well, getting whacked versus American stocks. And government bond yields had a bit of a pullback here today, with the 2-year down to 4.46, the 10-year down to 3.67. But Fed Fund futures still holding up there, still saying we've got 1 or 2 more hikes left in the bag before they pause and maybe cut by Christmas. And with those lower yields, we've got TLT looked to have found support and bounced off it a little bit here. Dollar holding strong at 104. Bitcoin looked to be rejected off its 50-day VWAP. And tough day for commodities, look to have lost this support zone we've been watching here today. But gold the exception, hanging in there, looking to climb back up to 2,000 an ounce. And the reason we saw commodities come off today was crude, fell pretty hard down 4.5%. There's the AI ETF bots. Had another good day as the NVIDIA craze spreads to the whole sector. And if you remember at the start of this video, I was going to tell you an ETF that I added to today in my long-term portfolio is the Clean Energy ETF PBW. And if we just go out to a monthly chart here, you can see we've come off quite a lot. Now down 75% since it peaked back in early 2021. And of course, this is really volatile and could still go lower, but I added it to my long-term portfolio as I like the valuation here. We've got almost a 5% dividend yield, and I think this is one of the biggest secular trends of my lifetime. That's the world switching over from fossil fuels to clean energy. And this is a fund I plan on to hold for many, many more years, if not decades. Got a bump up in the overvalued stuff today here with ARK up 1.8%. And just lots of green across the board in the growth sectors. There's discretionary up, semis up again, but did close lower than when we opened, really overbought up here. The energy and oil and gas sectors coming off as you'd expect with that price of crude falling. And the defensive sectors, healthcare, staples, and utilities still trying to find support. Tesla had a good day. We've got some encouraging price action as we approach year-to-date highs. It's moving up on strong volume. And just a quick look at our stock fair value indicator, which you can get access to from our site, clickcapital.io. It's still got fair value on Tesla at 219, so still a little bit undervalued here. And if you go back in my videos in mid-January, I actually called the bottom back here down in the low 100s and was adding to my long-term position. As I'm a long-term holder in Tesla, and I will never sell a core position that I hold into it. Here's a quick look at NVIDIA after hours. We're trading at $3.99. My latest ad on the short was $4.14. Before that was $3.92. And of course, this is a risky trade. I'm not saying it's topped out yet. We could still see $500 a share. Shorting momentum, hype, and bubbles like this is never easy. And that's why I don't recommend it to anybody. This video is not financial advice. I'm just sharing with you my positions, thoughts, and opinions on the market, and just a small position as part of a diversified portfolio. And I could still be wrong on it. However, I just think it's really technically overbought up here. We've got the whole candle above our buy-sell band. This is on the weekly chart. We could be starting to perform a potential reversal formation now. And other things give me confidence, like Jim Cramer saying, valuation's more of an art. Kind of implying that this time is different. And just a quick look at our stock fair value indicator. So, the fair value did jump from before earnings. We had it at 147. Now it's at 185. It's still significantly overvalued. But of course, no one knows when exactly this will top. It still could get a lot more crazy. Staying on the weekly chart, here's Apple coming up to all-time highs in a bit of a resistance zone around 180. Same with Microsoft getting up there, really extended here on the weekly, coming up to all-time highs around 350. Amazon not quite there yet, neither with Google. Same with Meta. AMD's ripped up. Netflix still on an uptrend. And over to the meme stocks, quite a few big moves in the space here today. And at the start of this video, I was going to let you know another stock that I shorted today. And that is none other than Coinbase. So technically, I think we're stalling out here. Got a lot of overhead resistance. Got a bit of a negative divergence on our hidden divergence indicator. I can see there's no momentum in the stock on our range strength indicator. And fundamentally speaking, the US government is unofficially trying to shut down crypto in America. No doubt they can move offshore and Bitcoin will always be around. But I'm just speculating, when the biggest market in the world is trying to shut you out where you've headquartered and started. That can't be a good thing, so I think they've still got a lot of troubles ahead. And when you look at the price of Bitcoin itself, it's stalled out at the resistance zone at 30,000 a coin. And is well off its bubble peak here. So obviously this will have a big influence on the stock price of Coinbase. And as far as I'm concerned, the price of Bitcoin itself is not in a bull market, it's in a sideways market at best, if not it's just retracing in a bear market. And a quick look at our stock fair value indicator. We've got fair value on Coinbase at 38 a share, so still overvalued by 58%. And I'll be looking to hold my short until we get down to that fair value. Our business quality score indicator has got really low, -68, indicating it is a really low quality business. And fundamentally speaking as well, they charge huge fees, which customers are starting to figure out. And it's just simply unsustainable when you charge these 4 or 5% fees and spreads just to buy some fake funny money. It's kind of ridiculous. But that AI craze is helping the meme stock crowd feel alive again. Here's Carvana up 16% today, and SoFi as well up 11%. Along with Palantir up 7%. Carl Icahn stock trying to bottom out here today and hold above $20 a share after being absolutely smashed this last month. And not much to report in the banking space here today. They're all kind of flat and just hanging in there. Okay, just to wrap it up here today, much again of what I've been saying for the few weeks. Still got a lot of divergences in this market. I think this market grows more and more phony by the day. Got a huge divergence here in global net liquidity in the market. And even though the main indices are breaking out, thanks to mega cap tech, if you look at the equal weight S&P 500, it's in a downtrend. We're underneath the 50-day. And with all that, I'm continuing to stay 40% net short. So I got a lot of longs and shorts, but overall still tilted a bit net short as I think the risk is still to the downside. And that's all I've got for you today. Thanks very much for stopping by. And if you haven't already, hit that subscribe button and you'll get these videos showing up on your YouTube homepage. And I'll keep you updated every day after market close with everything important that's happening in the markets. And also sharing some trades I'm taking and just my thoughts and opinions on what's going on out there. All right, guys, see you again tomorrow afternoon.